take real estate as a shot or as a fully stocked cooler? This is the 5 o'clock somewhere Real Estate Investor Podcast. We're bringing common sense back to real estate investment. So crack open your beverage of choice, sit back and relax, and allow us to learn you a thing or two.
All right, welcome back to 5 o'clock somewhere Real Estate Podcast, 901-692-7401, mymemphisinvestmentproperties.com. Today, we're going to talk about the long-awaited, anticipated rate drop. So stay with us. We'll be right back.
We are sponsored by Title Assurance and Escrow, a title company here in Cordova that does all of our closings, title work, escrows, and we only use Title Assurance and Escrow. That relationship is very important because we can get things done for our investors quickly and easily. So to speak with Title Assurance and Escrow, call 901-737-3332. Ask for Chris or April.
All right, welcome back to It's 5 o'clock somewhere Real Estate Podcast. I'm Brett Bernard. In the studio with me is Nick Gibson, Jeff McNett, and our Palmy producer from Britain. Hey, I just realized something. You're a true Southerner. Redneck Southerner. You have two first names. Richard Roy. Did you know that? It's like Billy Bob.
That is so dumb. There's nothing to say to that.
I'm just saying, you're probably redneck. You don't even know.
You've got two first names as well.
Bernard is not a first name.
Yes, it is.
But I don't know any guy's first name Bernard.
You go to South Africa, you go to the UK, they actually say it Bernard.
I ain't talking about the UK and South Africa. I'm talking about the South.
Can you say Palmy?
Palmy.
And redneck.
Is Palmy a curse word?
I don't think
probably in Britain it is.
I don't think you can say Palmy and redneck on air. You just offended half of our audience.
But redneck is a state of mind, isn't it? You find them everywhere.
I'm a coon ass from Louisiana. I'm very damn proud of it. So
that's two more cuss words.
Well, I was going to say, we literally just spoke about this.
That's 4 cuss words in 30 seconds, Brett.
That's not profanity, though.
That's not profanity.
Okay.
Curse word and profanity are two different things. So I can cuss. I just can't be profane about it. All right, so today we're going to talk about the long-awaited rate cut. So does everybody understand what basis point is? Basis point is 1/10 of 100th of a percent. So you take 1%, break it up into hundreds, right? 100 points. So a 50 point basis drop is basically a half a point. That's the easiest way to equate it. So, Jeff, what do you think is going to do to the market now?
Well, before you get all excited, it's going to take some time for this to catch up.
True.
And what you've got to realize is a lot of these mortgage companies and lenders have already anticipated in that drop into their current rate that they're offering now. So this could take a couple of months, but overall the perception, I think it's great. I mean, it's going to get people off the fence, and they're talking about another quarter to a half a point in November, another quarter to a half a point in December.
Yeah.
So if this keeps going, it's going to put everybody in a good position first quarter of next year.
I think it's definitely a step in the right direction. I'm still a little concerned about the election and what effect that might have, however it turns out. And I personally think that a lot of the investors are just kind of pulling the reins back and waiting to see what happens.
Well, what needs to happen, we should have had a 3-point drop. That would have ensured Kamala Harris to get elected in November, and then we all could have gotten $25,000 put down on a house. But we only got a half a point, so we'll just have to deal with it. Hopefully that's enough to push her over the finish line.
Maybe so. I doubt it, but maybe so. So,
do you think the public genuinely thinks that?
Thinks what?
That interest rates are so tightly connected with who is in office? Because there is no
correlation.
There's zero correlation.
Exactly.
It's just perception of things are better.
Listen,
it's going to curb inflation. It's going to create jobs. It's
going to
stimulate the housing market. It's going to stimulate building.
We're in a point in our culture that everything's run on emotion, right? So simply a half a point cut that's nothing. It's not like everybody's just going to all of a sudden tomorrow start making tons of money and everything's going to turn around. But mentally, right, and emotionally, it gives people confidence. And that's all you need, confidence. And I've talked about this before, back in 2007 and 6, when the best rate you can get as an investor was 10.5 points, 10.5%. And they thought that was fantastic. Then they dropped it to like 9, and people went bananas. Like they really thought they were just dumping gold bars into their suitcase and taking them home. As soon as that shifted, it turned everything on its head. And simply because I think the emotional part of it, not the business part of it, is what connects with these people. And it connects with investors too. Listen, let's face it, a lot of investors out there are new, and they don't have a lot of experience in this world. So they do emotional buying. They make decisions based on how they feel. They make decisions on things that have really nothing to do with the business plan. And that's why I think I agree with Jeff. It's going to take a little time for it to catch up, but I think emotionally and mentally people are feeling better. Now, whether that pushes them to buy something, who knows? Time will tell. But, I guess our rates now, we've been averaging around 6.25 has been a good average rate. So 5.5, 5.75 would be a good rate. Now, investor rates probably won't take as big of a dip. They don't have to. Those are going to remain in the maybe to the mid 6s instead of 7s, which is still good. So I'm optimistic.
How far above the other rates do those investor rates typically ride?
Depends on the lender and the investors. I've seen them as high as 8.5. I've seen them as low as 6.2. So it really depends, because when you're dealing with investor rates, it's really just lender competition. There's not a set standard that, like FHA, when they set a rate, it's set for everybody, whether you're buying $400,000 house or $100,000 house. In the investment world, that doesn't apply. It's pretty much whatever the bank wants to charge you. And if you agree to it, that's where you're at. So Jeff, you mentioned you think there's another rate coming. I've heard talk of a quarter rate drop in another 45 days. Yeah, but I also heard that it's only based on what happens in the next 45 days. If the economy begins to stabilize, actual inflation starts to come down, and things look like they're on the right track, then they may not reduce those rates again.
No, I don't know if you can determine all that in the next 45 days. They're pretty optimistic that inflation's already on the decrease, buyer sentiment is up, jobs are being created. The big dilemma is the shortage of inventory. You got sellers that aren't selling because they're afraid they're not going to be able to purchase a new mortgage at a higher rate. You've got builders in decline. They're not building anything right now. So again, it's just going to take some time to catch up. And I think the only way they're going to, I don't think a half a point is going to make that much of a difference. Short to midterm. But if you drop it again in November, you drop it again in December, now we're looking at something substantial by the first of the year. That's going to create jobs. That's going to create stuff in the real estate market. People are going to start building houses again. Prices are going to come down.
Well, put a number on those percentages. So I did some research to try to find, all right, so what does this mean to a buyer? And the one example I kept finding over and over again is if somebody buys a $400,000 house and they get a half a point rate drop, it saves them $100 a month. So a point on a $400,000 house would be $200 a month. So let's say we get a 1.5. Then that's $150 a month off of someone's mortgage payment. So we're not going back to the days where you can get out of college and buy your mini McMansion and your Land Rover and have your 2.5 kids and your 0.325 dogs. You're not going back to that day, but we're getting to a point now where people will be able to afford what they can afford. Like right now, people who should be able to afford a $350,000 house can't. Simply because their payment's too high, only because of interest rates. So I think we'll see that balance off, I'm thinking, before the end of the year. Now, the guys are predicting that in 2025, a huge year is coming. If we get 2 more rate drops, I agree with that. If we get stagnant and we don't have another rate decrease, I think we're going to go into 2025 a little sluggish. I think it's going to take some time for all of that to ride up. Now, as an investor, I had a guy that called me. He came from one of our lenders, Andrew. So I talked to this gentleman. I forgot where he's out of. Anyway, he was buying a property in Little Rock and bought his first property. He says, I've got a friend that owns 45 properties. And I've been telling myself every year, this is my year, I'm going to buy properties, but I just didn't do it. And I went and had dinner with him, and he looked at me and goes, well, why aren't you buying properties? He goes, well, I'm waiting on interest rates to drop. He goes, why in the hell would you do that? And it made him think. He's like, well, why wouldn't I? He goes, you do know what's coming. This is the guy that said he is 100% convinced a recovery is coming. And he goes, what's going to happen in a recovery? He goes, values are going to go up. Profitability and cash flow will go up. He goes, then why aren't you buying now? Don't worry about the rates. A half a point is going to, on a $100,000 house is going to save you $20 a month, right? That's what it equates to. You pay an extra percent in interest on a $150,000 rental house. It's going to cost you $60 a month more than you would pay if the rate was lower. And that's not enough to gamble on the ability to buy something that you're going to see a 10 or 15 or 20% increase in value and a good jump in rents over the next year or two. So right now, when things are depressed, or as they say, are depressed, would be the best time to buy. But what I find is a lot of investors we call them coat tailors, right? They want to wait for everybody else to do it. And then they'll jump on the bandwagon and pay retail at a higher number just to say I bought a rental property. True investors understand how to watch the market and understand when's the right time to buy. And interest rates has nothing to do with that. Absolutely nothing to do is when is the right time to buy. If you're waiting on interest rates to determine whether you buy or not, then you're in this for the cash flow and you're not really an investor, because as we discussed, Jeff and Nick, cash flow, you're never going to retire in this game on cash flow until you build a nice, sizable portfolio.
No cash flow. How many times have I told you dump all that money back into that property, build a reserve account, use it for maintenance, repairs, build that reserve account more, start buying down that mortgage.
Now, there's an argument to be said, interest rates don't affect property value. It may affect or slow down property growth, but it doesn't affect property value. What it does affect is cash flow. So if you're getting into this for cash flow, then interest rates are a big deal, but you're getting into investing for the wrong reasons. You're not getting into investing to build yourself a asset-based portfolio of real estate that has a value. You're getting into it just so you think you can get money each month and quit your day job, which is a bad move. So now is the time to be buying. I think we've said that on this podcast multiple times in the last 6 months. Now is a good time to buy. You can still get a good deal on a property. And then when 2025 hits, let's say there is no big recovery. Okay. So you paid $100,000 for a house that's worth $101,000. Great. Well, let's say there is a recovery, and now that $100,000 house becomes worth $120,000 in the next 12 months. Would you have rather bought it at $120,000 or take the risk that you're not going to make a dime and break even, or maybe make an extra 20% equity in your property?
You would anticipate that much of a jump in property values?
Only if you look at
as opposed to the normal 4.5-5% increase.
Well, if you look at the history of real estate, as it's tied to the economy and inflation and interest rates, if you really go back and look at that, every time there's any kind of significant recovery in this country, stocks do well, bonds skyrocket, real estate jumps, right? And all of that is due to the fact that the consumer has more money in their pocket for whatever reason that they don't today, but they do now. And it just causes, when they start spending, the entire market is lifted up. So in the real estate market, every time we have a recovery, and we can go back and look at it from Reagan taking over from Jimmy Carter, look after the 2008 crash, there is always a recovery when things are down for a period of time, especially this long, 3 years. And when that recovery hits, things just take off. Now, it doesn't mean it's worth what it's gone to. It just means consumer confidence in buying is up. So therefore, that naturally dictates that the prices go up, naturally dictates that rents go up. Again, it's just a mentality. That's all it is. There's nothing driving that other than the mentality of the people that are out there in the market wanting to buy.
Yeah, my wife Layla and I were talking the other day about the fact that the whole election is a psychological thing.
Sure it is.
People get, like you were saying, emotion. Mm-hmm. People get psychologically involved with something if they feel like their preferred party is in power. Oh, it's great. I can get on with the economy. But in reality, the economy can often be good, but because their person is not in office at that time,
right,
they are a bit down in the dumps and they don't have that emotional enthusiasm they might have, and that affects how they go about doing business and doing daily life.
Right, I agree with that. Somehow in this country, we've gotten off the base of common sense and we deal with emotion as our deciding factor and our guiding light. And that is such a dangerous way to run a business, such a dangerous way to run your investments or anything in your life, right? I mean, common sense has to take place somewhere.
So it was a long time coming, but I think this is good news for the real estate market throughout the remainder of 2024 and on into 2025. We've still got the election coming up in just a few weeks. And no matter the outcome, I think we are going to see a market shift that will benefit many. So who's up for a bet on a bottle of Johnny Walker? Brett?
So regardless of what happens in November, I agree with Glenn, right? Glenn's message from the grave, that things are, if the rates are low, psychologically people are going to be more apt to spend money, invest money, and take a risk. Right now, people are scared, right? They're hoarding that little bit of cash they got in the bank because they don't know if tomorrow is going to bring another crisis, or if tomorrow they're going to have to take that savings out just to pay their house note or pay a credit card bill. So they're hoarding their cash. As soon as they feel like we can move forward and invest, they're going to start pouring that money into the market, go back into the stock market, go back into the housing market. And that's what's going to create this recovery. Now, let's say Trump wins the election. I'm saying this is going to happen on its own, regardless of who's in the White House. I truly believe that. But whoever's in the White House is going to get credit for that massive recovery. And that has long-term effects on the next election and the congressional election. So it is a big deal. Jeff, what do you think?
It is. It's all based on emotion. I mean, Richard, you can take a guy listening to the radio on the way home from work, and he hears that the stock market jumped up 2,000 points. He doesn't have any money invested in the stock market, but he's going to go home and tell his wife, let's go down to the furniture store and buy that bedroom set we've been looking at for 6 months.
Mm-hmm.
Everything is emotion. And we blame or give credit to all of this on the government.
Was this an aforementioned redneck?
Yes.
Yeah, I mean,
absolutely.
It just is what it is. I mean, you look at all the people that get income tax refund checks. They think it's free money. It's their money.
We don't care about your credit. We just care about you.
Yeah, it's their money. But 9 out of 10 people will take that $2,000, $3,000, $5,000, $10,000, and they'll go blow it on a vacation. They'll go blow it on a living room set.
Buy a car,
whatever,
And believe it or not, when tax season comes up and you look at the numbers, the amount of renters signing new leases goes up.
Oh, absolutely.
So people that are paying $900 a month, they get a $10,000 return. All of a sudden they're like, well, you know what? I'm going to go up to $1,050 or $1,100, and they go find another house, a bigger house. So it does, but it's all psychological. Common sense tells you don't do that because the 10 grand is going to be gone in a couple of months, but they do it anyway.
Well, it's the Dave Ramsey School 101. Why in the world would you go out and, the first thing you do when you get married is you go out and get in debt for the next 30 years buying a mortgage you can't afford. The second thing you do is you go out and buy a $90,000 pickup truck. I'm a Dave Ramsey guy. Buy a nice pre-owned vehicle, pay cash for it, drive it for 10 or 12 years.
First thing I did when I got married wasn't that.
You were probably more sensible than the average young person in this country just getting started.
Come on, don't even start down that road.
And then you pour all the marketing and advertising into it and all the entitlement and everybody's important. I got to have this, The whole world operates on Brett went out and bought a $90,000 pickup truck. Now I've got to do the same thing because I can't let him outdo me.
Do you remember that commercial from a few years ago where he's grilling in his backyard and someone asks him, how have you got all of this? And he goes, I'm in debt up to my eyeballs.
Driving the riding lawnmower that he can't pay for and debt up to his eyeball. But that's the mentality of the American people. We consume.
Well, it's also the mentality of investors, right? I mean, I don't know how many investors I've talked to over the years that they just want to buy something. They want to be able to tell their friends, I got a rental property in Memphis. And they don't take the time to analyze it, do their spreadsheet properly, look at the reality of the property and the investment versus what you want it to be, but look at the reality of it. And they just want to buy something. And that happens a lot. Amish, when he first came to me, that's all he wanted to do was buy something. And it took me a good month of reining him in to get him to slow down a little bit. And he told me, we talked this morning, and he said, you know what? What you told me a year ago, you were absolutely right. He's like, thank God you slowed me down. I'd have 50 properties right now. I'd be bald and probably aged 20 years by now if you'd not slowed me down. But the mentality of the investor is going to start improving. We're going to get busy again. Anybody that's interested in investing, if you're listening to this podcast, we get calls all the time from the podcast. We'll be glad to talk to you about investing in Memphis. We're not just going to send you out and buy you a property. That's not what our goal is. Our goal is for you to buy one from us, be very happy with the results to where you want to buy 2, then 3, then 10, then 20. Most of my investors that I've had for 5 years have 20, 30 properties they purchased from me over the last 5 years. So we're very good at what we do. So 901-692-7401, mymemphisinvestmentproperties.com. And you can check out our website. We have a list of off-market properties on there. Anyway, I just want to throw that in there. So do we have anything else we want to talk about the interest rates? We've all predicted it's going to have a subliminal punch in the psyche of the American investor.
A positive effect.
Positive
one way
effect.
Or the other.
But do we think it's going to really roll us into the end of this year?
No.
Like boom?
Nope.
I think it's going to be a soft tickle to the marketplace.
Soft tickle. That sounds quite intriguing there, Richard.
I will show you.
Soft tickle. So, all right. So Richard's prediction is we're going to have a soft tickle to the market. Jeff?
We're going to get another rate drop in November and probably December, and we'll start to see some positive changes probably mid-first quarter next year.
Could be a firm tickle by the first of the year.
I was going to say a full-on latex glove. Boom. Bend over, Mr. Bernard.
But no, as we always say, that's a step in the right direction. But even in the bad times, Memphis is a great place to invest.
Yeah, and we talk about that a lot. And, I get it. If you're listening to us and you're in California and you don't know us from Adam, yeah, we're talking about the market we make money in. So you tend to think that we may be a little biased. But let's face it. I've been in this market long enough to know it's one of the best markets in the country because you can still get 1% all day long on whatever you buy here. And if you're on the fence waiting to buy, well, guess what? Rates just dropped. What's holding you back now? Because when 2025 hits and we get into the second quarter and things are rolling and things are jumping and going the right direction, at that point, it's going to be too late to buy because that $100,000 house you could buy today is now selling for $120,000, $125,000. It's still renting for $1,300, but think about the cash flow you'd get off of that. Think about your rate of return off of that versus what you're now going to get because you're going to pay an extra $20,000 for that property because it's become more competitive again. So you need to reach out to us and buy now and get prepared to ride that wave whenever it comes in.
You've mentioned before as well that the autumn is a great time in any year
Absolutely.
to be looking.
I think this autumn, fall, see in America, we call it fall. I don't know what y'all call it over in Britain, but we call it fall. If that is the case, we're dealing with a slow market because of interest rates and what's happened this year. And we're going into the winter months where things typically are slower because you've got people are thinking about Halloween, school's back in session, Thanksgiving's coming, Christmas, New Year's. So the last thing people are looking at is housing, right? It typically slows down. I don't know why most investors don't wait until October 1st or September 1st to start buying. But I guarantee you I sell more property in May, June, and July than I do the entire year. When the hottest time during the month, not just temperature-wise, but market-wise. But if you want to start buying, I truly believe between now and the end of the year is the best time to buy anything right now if you're going to buy an investment property because you can still get a good deal. If you wait until next year, I guarantee you'll regret it.
For more common sense real estate tips, listen and subscribe at 5o'clocksomewherepodcast.com. The 5 O'Clock Somewhere Real Estate Investor Podcast is a Sound Ideas Group production.